Well, thank you for joining us today. We're very fortunate to have the two co-chief investment officers of Evanston Capital with us. Evanston Capital is a hedge fund provider that Sendero has been investing with for the better part of a decade. And today we have Adam Blitz, who is one of the co-chief investment officers and the founder of the firm, and Kristen VanGelder, who is the other co-chief investment officer, and I will note, employee number one of Evanston Capital. With that brief introduction, let me just ask Adam and Kristen to introduce themselves and just tell us a little bit of their background.
Thank you, John. I appreciate that and appreciate all of Sendero's support. So joined Evanston Capital right at the start of the firm almost 24 years ago. Prior to that, I had two stints at Goldman Sachs. One was with the quantitative research group right when they were getting started, and that group was founded by Cliff Asness, who eventually went on to start AQR. Joined Cliff and team at AQR at the outset as well, and then went back to Goldman in the prime brokerage area, which is really the group within Goldman that services hedge funds and studies them from a risk perspective, figures out how much leverage to extend to them. So brought all that background to Evanston Capital when we started the firm.
So my background is a lot simpler. I joined the firm in August of 2003, about a year into the business, as you mentioned, employee number one. So I've been working closely with Adam and at Evanston my entire career. So today in my role, really involved in all aspects of our investment process, from idea generation to research to portfolio construction and our ongoing monitoring of all of our existing investments.
And I will note there's a reason why you're based in Evanston, Illinois, and that's really one of your founders was also the chief investment officer for the Northwestern Endowment as well too. And that's sort of the background, I think, of the firm, and gave you part of your whole orientation, I think, from an investment perspective as well too. What we really want to sort of focus on and discuss today is on an annual basis, Evanston puts out a very good outlook for the hedge fund industry. And while we utilize hedge funds not to be necessarily a substitute for either equities or fixed income in our portfolios, but really to be a diversifier for our clients' portfolios from that standpoint, and really to offer a differentiated return, I think it's important to be able to understand some of the themes and some of the aspects that are really driving markets today. And I noted in your outlook, you mentioned this paradox that exists, the orderly surface but chaotic underneath of markets that exist today. How is that affecting how you're thinking about your portfolios from a standpoint? What are some of those factors that tend to drive that paradox, and how does that affect the opportunity set? Adam, I'll let you take that first, and Kristen, certainly if you've got thoughts, please pipe in.
Yeah, that's great. Yeah, no, I think you framed it exactly right. When you look at the surface level of S&P 500 or equity indices, it's generally been an upward trajectory with relatively limited volatility. I would say under the surface, though, just like you mentioned, John, there's just a ton of dispersion and change going on. Obviously, one of the major factors driving that is AI. There's so many effects of AI when you look throughout the world and at the individual company level. Obviously, you have chip manufacturers and things that we consider first order impacted or affecting AI. But then you have the power companies, who try to generate all the energy needed for AI, and then just brick and mortar companies, really in every sector, who's adapting well to AI, who isn't adapting well, who's going to be disintermediated, who's not. I think a very real time example of this is some of the pain you've seen in the software sector over the last several weeks, where I think people have said, boy, some of these software companies might not need to exist if AI can just code up that software, very, very quickly and simply. So a lot of change going on under the surface when you think about hedge fund strategies and being flexible to not only buy the things that you like and think are undervalued, but sell short the things that you don't like and think are overvalued. Hedge funds just have a lot of flexibility to try to understand those changing dynamics, understand that dispersion under the surface, and hopefully profit from that. In addition to AI, you have a lot of geopolitical uncertainty right now. You have a lot of tariff-related risks, right, that might impact company A and not impact company B, and understanding those dynamics as well, we think can also lead to a lot of dispersion within individual stocks and companies. So really excited about the opportunity set for that dispersion between winners and losers, and have a much stronger view on that dispersion will continue over the next period of time versus having a strong view on the overall direction, let's say, of equity markets.
Okay, that's most helpful. And I do think, the level of noise that's in the market today is just, it's almost more than most investors can handle, which is one of the reasons why we like to find strategies that can take advantage of some of that noise. But even if it's more on a longer term basis. Kristen, one of the points that you make in your outlook is that in long short, we're seeing a renaissance almost take place. And I would preface that by almost saying we went through a decade of the teens when it was incredibly difficult to generate return from long short equity. But in the last few years, Evanston has really created some very attractive returns. And I think a lot of that has come from long short equity. Can you go into a little bit of depth and explain how that opportunity set is unfolding?
Yeah, absolutely. I think we're seeing several more kind of structural reasons to think that this is going to be a really kind of durable period of outperformance for fundamental long short equity, not just kind of a quick flash in the pan. And I think I'd kind of follow that with a few supporting factors. So first is the dispersion that Adam mentioned. We're seeing increasing divergence in performance between individual stocks. And that's really historically the lifeblood of stock picker alpha. When stocks move more independently rather than in lockstep, managers that have differentiated views can generate real alpha. And given the degree of change that we're seeing right now, as Adam pointed out, we expect that heightened dispersion is really here to stay for some time. I think the second factor is we have normalized interest rates, so a real meaningful cost of capital. That helps long short equity strategies really in two ways. It's directly through higher short rebates, but it's also indirectly by contributing to that increased dispersion. We had near zero interest rates that encouraged risk taking and suppressed dispersion for years post global financial crisis. And then, today you have a very different set of circumstances. Certainly interest rates are coming down from peak, but we don't expect them to head back toward zero anytime soon. And then I'd say third, we think that there have been pretty significant changes in market structure that have led to higher alpha opportunities for fundamental long short equity managers today versus the past. So these are stock pickers that have a kind of medium term, kind of call it a multi-quarter or multi-year investment horizon. And just given the sheer amount of capital that we've seen within equities flow into either passive long-only vehicles or very short-term trading-oriented strategies like those that are pursued by the multi-PM platforms or quantitative managers, we think that fundamental long-short managers actually face far less competition today, and therefore higher alpha opportunity. And I think that's actually even greater on the short side of portfolios because we saw a longer-term trend in those years where, stock markets generally went up and to the right and dispersion was really low, a lot of hedge fund managers threw in the towel on short selling. And then even those that have stuck with short selling, I think, have increasingly turned toward blunter hedging instruments like indices and ETFs. So for the few managers that remain that are really skilled in short selling individual stocks, we think there's way less competition and, a very interesting kind of alpha setup. I would say, though, like the key in all of this, in capturing sort of this renaissance that we see, is going to be selectivity. So not all long short equity managers are going to succeed equally. And, I think a firm belief of ours is that, the ability to add value from portfolio management on top of good stock selection, really matters even more in today's market environment.
Those are great points, I think, to make. I think it's one thing really to emphasize that, we went through a period of time where we had zero interest rates and risk just couldn't be priced right. And I think when we look back in history, we'll realize that period was the anomaly. We're in a much more normalized period from that standpoint. But I think the other point that you've made is very important, and not just in terms of hedge funds, but also in terms of just equity exposure as a whole. And that is this idea that so much money is in passive investing that you almost get a momentum built into the market, and there's not real price discovery taking place at the individual equities all the time that's rational. And that can create inefficiencies, which is why we try to think, how do we invest so that we can take advantage of that. We've mentioned AI, and we just have to talk almost more about AI in some sense, because it tends to permeate everything. And last year we saw it driving the market in a very narrow set of equities from that standpoint. Now we're starting to see it broaden out. How are you seeing it in terms of affecting winners and losers out there? Because as you say, you think about the world from a long short side as well too. And so the opportunities are there on both the short side and the long side. I'll open that to either one of you, whichever one of you wants to address that first.
Yeah, I mean, obviously AI is critical to what's going on, in the world. I think when you look at last year, 2025, there was a lot of first and second order companies related to AI that were impacted the most. So again, the chip makers, some of the power and energy companies, as people said, boy, where are we going to get all this power to fuel all this AI investment? I think this year is going to be much more about companies outside of just that narrow universe, and really across every sector, right? Who's invested thoughtfully in AI, who hasn't invested thoughtfully or at all in AI, what types of businesses are going to be disintermediated. I think the classic example is the call center type of company that might have existed for decades and decades, hundreds of people in a room answering calls for a company for customer service. That company might not have any need to exist going forward, right? And that could positively impact the company. Call it like a cable company, as an example, who might have engaged a call center company to help with the customer service. Now they can use AI. They can do that more cheaply. They can probably do it better. That's good for the cable company using that. That's probably bad for the company, obviously, that's being disintermediated. But really, you could see it in every industry. Software, again, like I mentioned earlier, I think the market has really caught on to the fact that software, which for years was a darling, business, people subscribe, it gets embedded in their sort of company workflow, very hard to turn off. Well, maybe again, if you can code up something that's equivalent to that software, or maybe better or more customizable, you might not have the need to have that monthly subscription anymore to that company. Of course, we think, like often happens, the market tends to overreact or over extrapolate, and every software company is now getting seeing their stock fall a lot. And I think when the dust settles, you'll find there's probably some software companies that are going to adapt well and going to continue to thrive, and then many others who are going to be out of business. And so I just think it really impacts so many sectors. And I think this is the year in which you're going to start to see, all these investments that were being made over the last couple of years. Again, who did that smartly, who's adapting well, who's sort of behind the eight ball on some of that. And I think it's going to impact winners and losers across really every sector. And it just adds fuel to what Kristen was talking about how good the opportunity set is for long short equity managers. And I think people, their instinct when they think AI is to think, oh boy, I need a tech manager, a technology manager to figure that out. And not really. If you can find an industry specialist in any sector who really understands the companies and what drives their profitability, they can also assess how well they're sort of adapting to this new AI world and figure out the winners and losers in those non-tech sectors as well.
Thank you. In the U.S., we tend to take a very sort of U.S.-centric view of the investment universe, but the reality is the U.S. market on a relative basis gotten pretty pricey, and we certainly saw this last year to a degree. It started to express itself, but where the S&P 500 is trading at 22 times earnings. The rest of the world's probably trading at 15 or 16 times earnings from that standpoint. How are you seeing that sort of dispersion create opportunities for you in your portfolios and in the managers you're investing with?
Yeah, obviously, we already saw international equities outperform domestic last year. That was partly due to the weaker dollar. But I'd say importantly, we saw this stronger stock selection among hedge fund strategies at the industry level that extended beyond the U.S. last year. It extended into Asia. It extended into Europe. And I think that the setup for long short strategies in international markets looks increasingly compelling to us. This valuation gap, as you mentioned, that remains meaningful. But we're also seeing what I would say are important structural shifts in some international markets that could drive meaningful outperformance or alpha opportunities independent of just kind of multiple expansion or re-rating. So obviously we've seen the substantial fiscal stimulus package in Germany last year. It's significant departure from years of austerity. Japan's new leadership is very prepared to boost fiscal spending, I think, significantly. You have many emerging markets that are in a solid place in terms of debt to GDP today, and may have economic tailwinds from just increased demands for commodities, metals, energy, the things that they produce and export that are supporting this big build out that we have of infrastructure and electrification of the economy and et cetera. And then I think the third dimension is really, international markets also tend to have less research coverage, with the AI related stocks specifically. We think there's just way less attention today on stuff away from that, outside of the US or even down market cap. So if you have less coverage, less attention, we think that leads to a greater chance for mispricings that, skilled managers can exploit. So, again, I'd say it's more of a stock picking opportunity, long and short, than, kind of a beta or directional call for us. And our preference is to gain exposure to those international markets through specialist managers that have true regional expertise. They have language skills, they have on the ground presence, which, we think also leads to competitive advantages.
One of the areas that I wanted to address a little bit is with hedge funds, people tend to sort of don't really necessarily understand what all hedge funds are from that standpoint. And there are thousands of them. And I think you've always maintained that, yes, there may be thousands of them, but there are only a handful that you really want to invest with. But there's another phenomenon within the hedge fund universe that exists, and it's what I would sort of refer to as the pod shops. And while the returns in those areas have tended to be quite strong and fairly consistent for a number of years, there are risks that are associated with them. They're making up make upwards of 85% of the daily trading volume now in stocks, and we do see them doing a lot of the similar things from that standpoint. How do you think about the risks that they create within the hedge fund space, and then how that can possibly affect, the liquidity of the types of investments that Evanston is exposed to?
Yeah, I think when you look at some of the biggest risks in the history of any investment strategy, including hedge funds, it's often come down to some combination of leverage and illiquidity. And when you look at the pod shops today, and there's certainly some excellent ones, at one end of the spectrum, and probably some ones that have popped up at the other end of the spectrum, just to feed into investor demand. But one commonality is that they hire a lot of traders, hopefully who have some sort of small edge in their individual sector or area of expertise. They combine these traders, and then they utilize a lot of leverage on top of that in order to get to a total return that's attractive in investors' portfolios. And there's a lot of appeal to that package as an investor, in terms of getting all that exposure, getting something with a reasonably high, expected return, hopefully. But it also has some risks, right? And I think you've hit on them, John, in that a lot of the liquidity in markets today is driven by these pod shops, right? And a lot of managers, when they look at their portfolios, whether it's a pod shop or another hedge fund or even a long only manager, might say, boy, I have a pretty liquid portfolio. It only represents, a few days of volume if I trade 20% of an average day's volume. And our strong view is that those types of liquidity statistics can be very overstated, because a lot of the daily volume is just driven by one pod shop trading with another pod shop, or one passive sort of index provider or ETF provider trading to gain exposure, based on inflows, into or out of that ETF in a given day. Not that much volume in a given day is necessarily investors who need to get out of a particular security, right, or change their mind on that security. So when people are trading with each other in the ordinary course, the markets are fairly liquid and well functioning. But if something changes where people change their mind quickly, they reverse course quickly, and in the case of pod shops, you have a lot of people who are sort of trying to do the same thing and all sort of using the same amount of leverage and using the same risk models. In our mind, it creates this big liquidity risk or deleveraging risk if something unforeseen happens. And you've had little tastes of this. DeepSeek, if you remember, that day in 2025 was an example where everyone was super bullish on AI. All of a sudden, this DeepSeek thing came out of nowhere. Everyone got worried about AI, and people quickly kind of reversed course. And you had some very severe movements in individual stocks in a given day, because everyone was trying to exit through this very narrow door, and so many people had similar positions on. You've seen it recently with some of this negativity in the software sector. You've seen it around events like Liberation Day. So there have been like little tastes, if you will, of some of these liquidity pressures, and we think that there is a lot of concern as it relates to pod shops specifically, just because of the amount of leverage that collectively they have and the amount of volume that they control in a given day. I should say that among pod shops, again, there's different ends of the spectrum. There's some who have very locked in investor bases. They have very strong margin terms with their prime brokers, such that it might mitigate, some of the risk of them having to deleverage in a short period of time. Then at the other end of the spectrum, you might have pod shops with weaker investor bases, who don't have particularly strong margin terms with their prime brokers, and might be forced to delever in a much quicker manner. And when you're forced to delever to meet a margin call or to meet an investor redemption, you really don't have the luxury to pick and choose what price you're selling at. You have to delever quickly to meet that margin call or that investor redemption, and that kind of forced liquidity into the market can move prices in a fairly severe way, and that can start to impact other managers and other strategies, which might be stronger hands. So I do think the liquidity statistics, generally are overstated, and it's something that we pay a lot of attention to when evaluating our managers, the assets under management that they have, the amount of leverage that they're employing, hopefully is conservative and appropriate. Because it's very easy to buy something. It's not as easy to have to sell out of it in a short period of time if you have to.
And you also don't want to be forced to have to crystallize those losses in that sort of time of stress either, which is the other point. And let me shift to another area that's related though, but it tends to be very sensitive to liquidity as well too. And that is, in terms of credit, we're seeing more and more dispersion within the credit markets. We've seen some instances of defaults. They all seem to be idiosyncratic at this time. We always worry about if that's going to shift, but there's concern about the K-shaped economy and sort of who are winners and losers. And well, credit spreads tend to still remain pretty tight. This is always a place that's pretty susceptible to liquidity as well from that standpoint. From your perspective, are credit markets underpricing risk right now? And how are you sort of thinking about where the opportunities are in the credit space?
Yeah, I mean, excellent point. I mean, you're totally right. The index level high yield spreads are very tight. I mean, they're well below their 5-year averages. They're approaching historic tights. And if you just looked at that, I think you would say, credit risk is minimal, or at least you're not being compensated very much for taking credit risk. But if you peel back the onion a bit, to your point, there is still some meaningful dispersion within credit by credit rating. So lower rated issues are still trading reasonably wide on a comparative basis. I think, as of kind of the end of last year, there was a difference of maybe 700 basis points or so between CCC and BB high yield bonds. And the difference kind of in similarly rated loans was even wider, I think well over 1,000 basis points. So it's sort of a similar theme to within equities. Like we think that dispersion leads skilled credit managers to be able to still find mispriced individual opportunities, both long and short. But to your question, are credit markets underpricing risk overall? We think in aggregate, yes. Especially with what we're seeing in the increase in corporate bankruptcies last year. We have a default rate that's roughly in line with long-term averages, but we think there are a few factors that are kind of suppressing that, making it lower than it otherwise would be, just due to the prevalence of things like liability management exercises, the usage of payments in kind, ways for companies to kind of kick the can down the road and avoid, a technical payment default today, but, could lead to more trouble or stress in the future. And we do think some of that is tied to the kind of K-shaped economic dynamics that we're observing, right? Like you have this aggregate measure of the overall economy that looks quite healthy, but masking sort of pockets of underlying weakness, higher income earners doing quite well, lower income earners struggling, some sectors really thriving and others not so much. So we think this does lead to an environment or a macro backdrop where there could be more winners and losers for their own distinctive reasons compared to, an economy where, just a rising tide kind of lifts all boats. So, we think that, credit managers, can find these kind of idiosyncratic opportunities. And then to your point on liquidity, market structure matters a ton in credit markets. And I'd say, especially in the loan markets, there you have CLOs as really the dominant source of loan demand, but they're also capped on the aggregate amount of lower rated loans that they can own. So that can lead to forced selling when, loans are downgraded, or if there's kind of any whiff of the potential for a default or a liability management exercise. CLOs often lack that restructuring expertise, and so they might want to sell. And you would see loans drop in price really significantly before that marginal buyer enters. So that can lead to stressed opportunities more from just a supply-demand function almost, or a liquidity reason for distressed debt specialists to take advantage of. But I think overall, we just think it's a time for credit investors to be much more discerning, right? You have tight spreads, rising bankruptcies. It's an environment where credit selection is really going to matter.
Yeah, it's not an environment for the naive. It's one where skill really matters, and and I think that's true. I just recently heard the term liability management. We sort of had to get our head around that in the loan markets. And the best way to sort of define that is liability management is really about extend and pretend that we've seen exist in loan markets and in credit markets before. Always something that ultimately creates opportunity, but it can be tough living through it too. Let's shift just to one last area, and that is the whole sense of deglobalization, the fact that economies are not as synchronistic as they historically were from that standpoint. How is that creating opportunities in the macro space for you in 2026?
Yeah, we're extremely excited about macro strategies. It's one of the best opportunities we've seen in a while, for just the reasons you laid out, John. You've got different countries kind of going in different directions. You have some countries who are fighting inflation. You have some countries who are trying to cut short-term interest rates. You have all this geopolitical kind of tension under the surface. You have a lot of defense-related concerns related to AI and who's going to get the best chips and who has the commodities to build those chips and who's going to have the power generation to fuel AI. And so you just have a lot going on from a geopolitical standpoint, and all of that leads to tremendous opportunities in macro strategies, we think, where managers have the flexibility and ability to go long one country's stock market, short another, pick various points along a country's yield curve, either in an absolute basis or relative to one another, express views on commodities. Like we've all seen the huge moves recently in gold and silver. There's concerns about fiat currencies, given everything that's going on. You've seen copper rise recently as people say, boy, we're sort of undersupplied there, and demand is very high. Exactly like Kristen was mentioning earlier on long short equity strategies, just because there's a good macro opportunity set doesn't mean every macro manager is going to do well. There's still a very select group of macro managers we think that can really take all that data and information and distill it down to what are the best trade opportunities and what's the best way to express those opportunities in a portfolio context, and be thoughtful from a risk management perspective, and be on your toes. I think one very important component with this market right now, and what you mentioned, sort of each country for themselves, is that traditional models of risk might not be as effective going forward as they've been. A lot of quantitative risk models are very backward looking. They assume a fairly benign environment in which you do have globalization. You don't have such stark differences, let's say in the US, along party lines, where it's like, boy, the policies we have today could be very different in 3 years and have profound implications. And so if you're just relying on old paradigms, old risk models, backward looking data sources to inform your judgments today, you could really be misled, and you could end up taking much more risk than is really prudent. So this is something really it's important to talk to the managers both about how are you distilling all that information into your portfolio, given that amazing opportunity set, but also how you're thinking about risk management, and to the earlier conversation, maintaining enough liquidity in your portfolio and recognizing that things can change very quickly and you might have to pivot your portfolio very quickly and maintaining the liquidity and flexibility to do that. But it's a great opportunity set. We really think that, and it's in complete contrast to the decade of the 2010s when, if you remember, volatility was very low. Every country essentially was doing quantitative easing. There just wasn't as nearly as much as there's been to do this decade, where you've had COVID, right? And then you had the growth stock sell off in 2022 and all the tariff risks and AI and all these things in recent years. It's just been a much more robust and rich opportunity set in macro.
Yeah. Thank you. That's helpful. When you mentioned sort of the 2010 decade and the current decade, I was just sort of thinking about it. We had a Treasury Secretary that was an academic in the 2010s, and then we had one who was a really good distressed and restructuring manager, almost from that standpoint. But today we've got a Treasury Secretary who was a macro hedge fund manager for most of his career too. So it just sort of speaks to the importance of all of these areas. Well, I want to thank you today for joining us and for all the insights that you provided. Certainly the hedge fund arena is one that we think requires a lot of skill in terms of selecting where you want to be invested in and who you want to be exposed to. And we've been very fortunate to be able to work with the team at Evanston to really build that in portfolios. We look forward to another eventful and another successful year investing in this space. So thank you.
Thanks,
Thank
John.
you, John.